Hi folks, Clay Webster here with another FXStreet trading video. After last Friday's tariff-induced sell-off being followed up by Monday's recovery rally, most traders want to know if it's safe to get back into the US stock market. And I'm here to tell you, it really depends. That might not be what you want to hear right now, but let me break it down for you. Hey, if you like videos like this one, make sure to subscribe to our channel. The S&P 500 crashed 2.7% on Friday, October 10th, anecdotally sending an entire generation of zero-day to expiry options traders to the poorhouse. The massacre followed President Donald Trump's threat of 100% tariffs on China for its purported partial export controls on rare earth minerals. Then, after we saw an entire generation of degens destroyed by madness, Trump followed up on Sunday with, "Don't worry about China. It will all be fine," in a new version of the taco trade. The S&P 500 resurrected itself to close up 1.3% on Monday, and the Nasdaq regained over 2.2%. Phew. So the worries are behind us, right? Well, unfortunately, the outlook is a bit more complicated. You see, what we had on Monday's S&P 500 daily chart is called an inside day. An inside day is when the entirety of the lows and highs trade inside the previous session's candle body. What that tells us is that despite the fierce recovery on Monday, the market is still weighing its options. It could go up, it could go down, but overall, it's checking the time rather than hopping on the escalator. You see, despite President Trump calling off his dogs, he told reporters that 100% tariffs would still hit China come November 1st if President Xi doesn't budge on the rare earth policies. And word in the Chinese media is that Xi's decision is final. If that is the case, we should see the market prepare for a pullback as we get closer to that date, since a move back to a trade war footing between the two largest economies in the world will have major earnings ramifications. Tuesday has given us further market weakness despite Q3 bank earnings. A Bank of America survey of fund managers finds that 54% think that we're in an AI bubble already, while at the same time, China levies port fees on U.S. shipping vessels, showing us that the trade war is very much still alive. But on the flip side, we are now over 120 days into a rally that hasn't corrected 6% even once. This hasn't happened since 1966, demonstrating the fierce momentum of the buying pressure, led by the AI capex frenzy. OpenAI has introduced still more partnerships this week with Broadcom and Walmart, while risk-on quantum computing stocks saw one of their strongest rallies to date on Monday. These headlines tell us that there's still fuel in the engine for another climb into year-end. But here's the thing. There's no need to take a side in this matter. The chart will just give us the answer. Just wait until the market closes above last Friday's high or below last Friday's low. Those come at 6,762 on the high end and 6,550 on the bottom side. If the S&P 500 closes above that candle's high, then go long. If it closes below that level over the next 3 weeks, it's a clear sign to move to the sidelines. As always, best of luck and be safe out there. And once again, if you liked the video, hit the like and subscribe buttons and share your thoughts in the comments.